All right, today we're going to unlock a really powerful tool that helps you see investment risk in a completely new light. It's called modified duration. Now, I know it might sound a little technical, but stick with me because by the end of this, you'll see exactly how it can make you a much smarter investor. So let's kick things off with a question I think every single one of us has wondered about. When interest rates start moving around, why is it that some of your investments barely budge while others seem to jump on a wild roller coaster? What is that hidden force making them so different? Well, at the very heart of it all is this fundamental seesaw effect in the world of finance. It's pretty simple. When interest rates climb, the value of most existing investments, especially bonds, tends to drop. And you guessed it, when rates fall, their value goes up. It's this simple inverse relationship that really sets the stage for everything we're about to cover. Okay, but just knowing they move in opposite directions, that's not really enough, is it? The real million-dollar question is, by how much? How can we actually put a number on an investment sensitivity to these rate changes so we're not just flying blind? To answer that, we need a specific tool. And to really get it, we first have to take a quick look at its predecessor, which measures something we're all very familiar with: time. So first up is this thing called Macaulay duration. Don't let the name scare you. All it is the average time in years it takes for you to get all your money back from an investment. That's it. It's not about risk. It's purely a measure of time. But this is where the magic happens. Modified duration takes that simple measurement of time and transforms it into a powerful measure of risk. It literally tells you, in a percentage, how much an investment's price is expected to change if interest rates move by just 1%. This is the number that really quantifies that sensitivity we're looking for. And you know what? The calculation is surprisingly simple. You just take that Macaulay duration we just talked about, and you divide it by 1 plus the current interest rate. That's all there is to it. That one little step turns a measure of time into an incredibly useful measure of risk. All right, enough with the theory. Let's make this real. We're going to look at two different investments side by side to see how modified duration actually works out in the wild. So check this out. We've got investment A and investment B. As you can see, they're in the exact same market with a 10% interest rate. The only real difference here is that investment A has a slightly longer Macaulay duration. That just means its payouts are, on average, a little further down the road. So let's run the numbers. For investment A, we take its Macaulay duration of 6.03 years and divide it by 1.10, and that gives us a modified duration of 5.48. Now we'll do the exact same thing for investment B. We take its shorter Macaulay duration, 5.80, divide by that same 1.10, and we get a modified duration of 5.27. And when you see them laid out like this, the difference is crystal clear, isn't it? Even though their time horizons were pretty close, investment A clearly has a higher modified duration, and that tells us it has a very different risk profile. So what do these numbers actually mean for your money? Well, it means that if interest rates were to go up by 1%, we'd expect investment A's value to drop by about 5.48%. But investment B? It would only fall by 5.27%. That seemingly small difference in duration actually makes investment A the more sensitive and, yeah, the riskier of the two. This simple comparison actually highlights something much bigger about how markets work. It's an idea I like to call the accordion effect. At the end of the day, it all boils down to this one simple rule. The longer the duration, the more an investment's price is going to stretch and shrink whenever interest rates change. Higher duration simply means higher sensitivity. It's a direct link. To really get a feel for this, picture the entire landscape of investment opportunities out there as one giant accordion. And this visualizes the dynamic perfectly. When interest rates are low, money is cheap, and that accordion expands wide open. Investors feel confident, and they're more willing to pour money into those big, long-term, higher duration projects. But when rates start to climb, the accordion gets squeezed shut. The focus snaps back to short-term, lower duration investments that feel safer. So let's bring this all home. What's the bottom line here? And why does any of this actually matter for the decisions you make?
Okay, here's what you really need to take away. Modified duration isn't just some abstract number. Think of it as your personal risk meter for interest rates. If you want stability, especially when rates are rising, you'll probably lean towards investments with shorter durations. But if you're okay with more volatility because you're hoping for bigger returns when rates fall, then a higher duration might be your play. It's all about using this to align your portfolio with how much risk you're actually comfortable with.
So the next time you're looking at an investment, don't just ask, what's the potential return? Go a step further and ask, what's its duration? Because now you know that second question is the real key to understanding the hidden risk. You're not just looking at a potential destination anymore, you're finally seeing the road you'll have to travel to get there.